You see these candles on your chart, those little red and green bars everyone looks at, but very few truly understand what they mean. Behind every candle, there's a story, a silent battle between buyers and sellers, a trace left by market psychology itself. Today, I'm going to show you how to read and understand candlesticks like a real trader. No more guessing, no more confusion when you look at your charts. Just get ready, because after this video, you'll never look at the market the same way again. By the end of this video, you'll fully understand what Japanese candlesticks are really telling you, their origin and concept, how it all started, and why candlesticks remain the universal language of trading. The structure of a candlestick, what each part means from the body to the wicks, and how they reveal the battle between buyers and sellers. The most important candlestick patterns, the ones every trader should know by heart to spot powerful market moves. How to read and interpret candlesticks. To understand what the market is truly trying to say. How to combine candlesticks with market structure. To find precise entry zones and sniper-level confirmations. And finally, the common mistakes to avoid, the ones that make most beginners lose money and confidence. So make sure you stay until the end, because after this video, you'll never look at candlesticks the same way again. If you learned something new today, don't forget to like the video and subscribe. It really helps the channel grow and keeps you from missing the next lesson. The origins of Japanese candlesticks, the secret language of the market. Before we start analyzing and interpreting candlestick patterns, it's important to understand where they come from, who created them, and how they became the universal language of traders. So let's go back in time to Japan a few centuries ago. One who created Japanese candlesticks. Japanese candlesticks were invented by Munehisa Homma, a rice merchant from Sakata, Japan. Born around 1724, Homma wasn't just a trader, he was an observer of human behavior. While trading rice, he realized that price movements were not only driven by supply and demand, but also by emotions, fear, hope, and greed. To visualize these market emotions, he developed what we now call Japanese candlesticks, a way to represent price movements in a simple yet powerful visual form. When were they created? The first candlestick charts appeared in the 18th century, around 1750 to 1770. Homma used them to track rice prices in the markets of Osaka and Sakata. He even wrote a famous book titled The Fountain of Gold, the Three-Monkey Record of Money, where he explained the psychology behind market trends. What did traders use before candlesticks? Before the creation of candlestick charts, traders mainly used simple price tables or basic line charts. Those charts showed price changes, but they didn't reveal the emotional story behind the movement. Candlesticks changed everything. They allowed traders to see not only the numbers, but also the strength, sentiment, and psychology behind each price move. Was their adoption easy? Not at all. For a long time, candlestick charts were used only in Japan. It wasn't until the late 20th century that they reached the Western world. The person who made that possible was Steve Nissen, an American analyst who discovered these charts and introduced them globally through his book Japanese Candlestick Charting Techniques in the 1990s. From that moment on, candlesticks became the standard tool for technical analysis worldwide. Have candlesticks changed since their creation? The core concept remains exactly the same. Each candle represents the open, close, high and low of a specific period. However, over time variations have appeared, like Heikin Ashi, Renko, or Kagi charts, designed to smooth or filter price movements. But even today, the original Japanese candlestick model by Homma remains the foundation of modern technical analysis. So that's how a simple rice merchant from Japan created a system that would transform how traders all over the world read the markets. Now that you know their history, let's move on to the structure of a candlestick and learn what each part truly represents. Understanding the structure of a candlestick. Now that you know the origins of Japanese candlesticks, let's take a closer look at how a single candlestick is built and what it really tells us about market behavior, the basic components. Every candlestick is made up of 4 key pieces of information: the opening price, the closing price, the highest point, and the lowest point during a specific time period. In other words, a candlestick captures everything that happened in that time frame, from the moment it opened to the moment it closed. The body. The body is the thick part of the candlestick. It shows the distance between the opening and closing price. When the body is green or white, it means the price closed higher than it opened. Buyers were in control. When the body is red or black, it means the price closed lower than it opened. Sellers dominated that period. The wicks, or shadows. The wicks, also called shadows, are the thin lines extending from the top and bottom of the body. The upper wick shows how high the price went before pulling back. The lower wick shows how low the price dropped before bouncing back. Together, they reveal the market's volatility and rejection zones, where buyers or sellers pushed too far, and the other side reacted. The colour and psychology. The colour of the candlestick is more than just decoration. It tells a story of emotion. A strong green candle often represents confidence, momentum, and optimism. A strong red candle can reflect fear, pressure, or panic. This is what makes candlestick charts so powerful. They combine price data and human psychology in a single, simple visual. What a single candle reveals. Think of each candlestick as a battle between buyers and sellers. The body shows who's winning, while the wicks show how hard each side fought. When you learn to read that battle, you start to understand the true rhythm of the market. Now that you understand the structure of a candlestick, let's explore the most important types of candles and what each one can reveal about upcoming market moves. There are many patterns in technical analysis, but in this video, we'll focus on 5 of the most powerful ones. These 5 are essential because they appear again and again on the charts, and they can give you a clear insight into what's really happening behind price movements. The engulfing candlestick. The first one is the engulfing candle. It has a large body that completely engulfs the previous candle, with very small or no wicks. This pattern often signals a strong reversal. When a bullish candle engulfs a smaller bearish one, it means buyers have taken control. And when a bearish candle swallows a bullish one, it shows sellers have regained dominance. The hammer candle. The second type is the hammer candle. It has a small body near the top and a long lower wick. This shape tells us that sellers pushed prices down, but buyers stepped back in, driving the price back up before the candle closed. It's often seen as a bullish reversal signal, especially when it appears after a strong downtrend. The indecision candle with a small body and long wicks. The third one is the indecision candle. It has a small body and long wicks on both sides. This pattern shows that buyers and sellers fought equally and neither side truly won. The market is in temporary balance, waiting to decide its next move. Such candles often appear before major breakouts or reversals, like a deep breath before the next big wave. The doji candle, no real body. The fourth type is the doji candle. It looks like a thin cross because the opening and closing prices are almost the same. A doji represents pure indecision. Despite the movement up and down, the market ends right where it began. Depending on where it appears, a doji can indicate trend exhaustion or a potential reversal. The Marubozu candle. Finally, the fifth type, the Marubozu candle. This one has no wicks at all. It's made entirely of a solid body. A bullish Marubozu means that buyers dominated from open to close, while a bearish Marubozu shows that sellers stayed in full control. These candles represent strong conviction and momentum, a clear sign of strength and direction. Of course, there are many more patterns: stars, hanging men, pin bars, and complex engulfing variations. But these 5 types are the most essential to master. They'll help you read the psychology behind every move and understand when the market is preparing to shift. Now that we've seen the main types of candlesticks, let's learn how to read and interpret them correctly. Each candlestick tells a small part of the market story: what buyers and sellers are doing, who's winning, and where price could go next. In general, we can group candlesticks into 3 main categories. 1. Confirmation candlesticks. These include patterns like the engulfing candle or the hammer. They often appear when the market is making a clear decision, for example, confirming a trend reversal or signaling a good entry or exit point. When you see one of these candles after a key level, it's usually a strong sign of momentum. Here we can clearly see how price was moving down, forming a series of bearish candles. Then suddenly a strong bullish engulfing candle appears, a clear signal that buyers are stepping back in. Right after that, price reverses upward, moving all the way to the previous high and reaches a key resistance zone. At that level, a beautiful bearish engulfing candle forms, a powerful sell signal for any trader who works with support and resistance zones. In this setup, all the trader has to do is place the stop loss just above the engulfing confirmation candle and set the take profit at the previous low. And as we can see, the market fully respected the setup. Price moved perfectly in the expected direction, and the take profit was hit with precision. As you can see, it's almost the same scenario every time, whether it's a buy confirmation or a sell confirmation. In this second example, you can clearly notice that once price came back to this resistance zone, the market gave us a beautiful bullish engulfing candle, which immediately triggered a strong upward move. And with hammer candles, it's exactly the same idea every time one appears at a key zone, like a major support or resistance. It's often a clear signal of a potential reversal. These patterns keep repeating again and again, and that repetition is what allows skilled traders to anticipate market movements with accuracy. 2. Indecision candlesticks. These are candles with very small bodies and long wicks, like dojis. They represent hesitation in the market. Neither buyers nor sellers are in control. You'll often find them near support or resistance zones, and they act as a warning that a potential reversal could happen soon. 3. Continuation candlesticks. Examples include the Marubozu or other large candles with no wicks. When these appear in the direction of the current trend, they confirm strength, telling us that the trend is likely to continue. Reading candlesticks is not about memorizing shapes, but about understanding the story behind each candle, the psychology of the market. Once you master this, every chart starts speaking to you clearly. Now let's move on to a crucial part of trading: how to combine candlesticks with market structure. Because in trading, a single candlestick is never enough. What really makes the difference is your ability to read the candle within its context, within the overall structure of the market, the trend, the highs and lows, the supports and resistances. Here's the key idea: a candlestick only has value when it appears in the right place. Step 1, identify the market structure. Before looking at candlesticks, you must know whether the market is in an uptrend, in a downtrend, or in consolidation. Then identify the key levels: previous highs, previous lows, support and resistance zones, liquidity areas. These zones determine where a candlestick becomes truly meaningful. 2. Step 2. Wait for a confirmation candlestick on the zone. This is where candlesticks become powerful. A candlestick is not just a shape, it's the market's reaction. On a support, a hammer or bullish engulfing candle can confirm a reversal. On a resistance, a bearish engulfing or a strong rejection can validate a sell. In a strong trend, a marubozu can confirm continuation. 3. Structure plus candlestick equals high-quality entries. When market structure and candlestick tell the same story, that's when you get the best entries, the ones traders call sniper entries. For example, price reaches a previous high, rejection zone. A bearish engulfing candle forms, sell signal. Your stop loss goes just above the candle, controlled risk. Never reverse the process. Many beginners look for the candle first and only then check the structure, but it's the opposite. Structure first. Candlestick second. This combination is what turns a simple candlestick into a reliable signal. Even if you understand candlesticks perfectly, you can still lose a lot of money if you fall into the mistakes that most beginners make. Here are the mistakes you absolutely need to avoid. 1. Focusing only on the shape of the candle. A candle means nothing on its own. A hammer does not automatically mean the market will reverse. It's not the shape that matters, it's where it appears. Always analyze the candle in the context of market structure. 2. Believing every candle is an entry signal. A bullish or bearish candle isn't automatically an opportunity. Many impulsive traders confuse a strong candle with a reliable signal. A candle is only meaningful if it confirms a key level. 3. Trading against the trend just because a reversal candle appears. Hammers, engulfing candles. All of these are powerful, but if you trade them against a very strong trend, you're putting yourself in unnecessary danger. Market structure always comes first, before the candlestick. 4. Ignoring wicks. Wicks tell an important story. They show where price was rejected. Many beginners focus only on the candle's body and miss crucial information. A long wick equals strong market reaction. Never ignore it. 5. Using candlesticks without proper risk management. Even the perfect candle at the perfect level can still be invalidated by the market. That's normal. But without a stop loss, one mistake can destroy your account. Always place your SL correctly, above or below the confirmation candle. 6. Searching for the perfect setup. The market is never perfect. A candle may be slightly bigger or slightly smaller. It doesn't matter. Look for the logic, not perfection. Final conclusion. So to truly master Japanese candlesticks, you must go beyond the shapes and learn to understand the psychology behind every candle. Combine candlesticks with the structure of the market. Avoid the common mistakes, and you'll start seeing the charts with a new level of clarity. Because in trading, the goal is not to predict every move, but to understand the story the market is telling, and act only when the story is clear. If you found value in this video, don't forget to like, subscribe, and activate the notifications to support the channel and not miss the next lessons. Let's keep learning, and I'll see you in the next video.